Hello, everybody. My name's Tim Gregory. I'm from Vermeer the Global Fund, and I'm joined today again by Charlie Fricker for the latest in a series of videocasts that we have done, trying to highlight our up-to-date views in what has been an extraordinary month for equities and for other asset classes as well, actually. As a reminder, we run a global long-only equities fund, which invests very broadly across all parts of the world. And obviously, it has been an exceptionally challenging 9 months in markets and a very tumultuous September, which actually, if you go back slightly to the Jackson Hole pronouncement, where Fed Chairman Jerome Powell made it absolutely clear there was to be no pivot in US interest rate policy, and the focus was very much on inflation. And, what followed that was then another inflation print that didn't actually really create any great hope that the worst was over in those terms. And so the Fed very much sticking to their task at this point in time. So, what we've seen from that are any number of shifts in asset prices, movements in the dollar that have been really quite extraordinary, not helped in the UK by the weakness of sterling. But Charlie, why don't you just fill us in on your thoughts for September of what we saw, what we have seen, and where you think things might be heading from here.
Yeah, as you said, Tim, that Jackson Hole was really the first kind of stage in the change in investor mindsets about the Fed's kind of resolution to sticking with higher rates to get inflation under control. And there were some reports that Powell was a bit worried about the market's perception that they would pivot, and hence he rewrote his entire Jackson Hole speech to make it much shorter and much more precise. And since that speech, we have seen slightly hotter than expected inflation prints. We've seen really solid non-farm payrolls reports that have given more reasoning for the Fed not to pivot. And I think that's now got into investors' mindsets, and markets have reacted accordingly. You've seen what the rates market has done in terms of where rate expectations are now. They're much more in line with the Fed's recently updated dot plot in terms of we're going to get more hikes into the end of this year, maybe one the next year, and then rates are going to stay higher for longer. And as you alluded to, this has led to continued dollar strength. It's led to a rise in treasury yields. And to us, the real question now after all of that is when the Fed narrative shifts more towards the other side of their dual mandate, which is being full employment. I think everyone's got the idea about them getting inflation under control, and it's now when do they start to focus on the other side of the dual mandate. Labour market's been incredibly strong over the last couple of years. Unemployment rate is still at around 3.7%, and until that rate starts to tick up more towards 5, that's going to us is more likely of an indication when the Fed may start to pivot. And to try and get a sense of that, we're keeping on top of as much high frequency data as we can, weekly initial jobless claims, continuing claims, things like that, along with company announcements. And we saw some stuff from Meta the other day about their hiring freeze and a restructuring of their business to right-size the company after huge amounts of investments over the last several years. And I think that narrative is where we are right now with the US. And it seems not fairly understood, but I think it's people have got their heads around that a bit more than what's the ever-changing news flow in the rest of the world, as we've seen with the crazy volatility in UK markets of late, haven't we?
Yeah, I mean, the situation in the UK has been quite extraordinary. I was travelling in the US last week, and I'm interested just to note that literally everybody I saw was bearish of equities. Some people were a bit more optimistic about fixed income given the pullback we've seen there, and that raises some asset allocation questions going forward when, of course, equities have been, there is no alternative trade for so long, but in the UK, things have obviously been really difficult. We have the new government coming out with some very aggressive tax cuts without a proper explanation as how they're going to be paid for going forward, and some dislocation caused by that via weakness in sterling and the weakness in the gilt market, and the fact that the Bank of England, obviously, when it really wants to start with quantitative tightening, has had to step in and buy long duration gilts to help the pension industry to function properly. I mean, these are astonishing developments, and obviously have been very worrying to markets, and I think actually have raised questions for all central banks about the need to be careful about policy here. So that that's a sort of separate question, of course, But tail risks are very important to be avoided, and it's one of the sort of things that's still sort of out there, as a negative thing that we need to worry about and keeps us cautious at the moment. But with respect to the UK, I mean, we have been quite bearish of sterling. We've kept a lot of the cash that we've held in our portfolio, which has been at elevated levels in dollars. We sold the last of our position in Pets at Home, the UK retailer, which is a business which we really admire. We've seen no problem with the company itself and look forward to being able to reinvest. But I just felt that the backdrop at the moment, heading into winter, high fuel prices, high and rising interest rates, Bank of England in a difficult position, government forced to already, this week, we've seen only the beginning of the week, retract one of the policies that they put in place that was deeply unpopular with many people. And we'll have to see, how far that goes, and to what extent the government, is able to get through its policies, or may have to change the timing in order to get those policies through effectively. But it's not just the UK. It's not just sterling that's been weak. The dollar's been the only game in town. We know how weak the Japanese yen has been. The renminbi's been weak. Obviously, sterling's probably been the worst. But, what about Europe, Charlie? I mean, it's not exactly roses and sunshine there either, is it?
No, it's not. You're right. Europe is likely already in recession. It did benefit from a strong summer tourist season, thanks to the weakness in the euro and the sterling over here in the UK. Combined with the ECB seemingly also in the same position, that they're resolute in hiking rates to try and control inflation, even though, in our view, most of Europe's inflation problem is more driven by energy and supply issues there rather than more demand-driven inflation. But all of this has impacted some of our positions in our portfolio, specifically the small and mid-cap area of the market. We've got three positions in that portion of the market. And despite this, actually, a few of them have provided some pretty reassuring updates recently. We had Professor, who were talking at some conferences over the last couple of weeks, reiterating the commentary they made towards the end of the last quarter in terms of where they expect to perform financially. And also we had Rationale actually upgrade guidance towards the end of last week. But despite that, stocks have been hit up really, really badly over the course of September because of this. They're German, it's exposed to energy prices, et cetera, and as a result, valuations have been hit up quite badly. But it's likely to be one of many in terms of pre-announcements or commentary going into quarter as we head into the all-important results season that starts in about a week.
Yeah, absolutely. And, we get results from the major US banks, don't we, in the early part of that season. And obviously, the banks have been forced to hold a lot of capital. They go into this situation in a very robust position, but all eyes will be on what they have to say about markets and the risks of dislocation and that sort of issue. And of course, from their own perspective, how they have continued to trade through this last quarter. But they're just a taster, aren't they, for perhaps the more important parts of the results season, results from the likes of Apple and Microsoft and Amazon and companies like that have been so robust and so resilient, and such powerful cash generators, and really grown to very strong positions. So how these companies are able to trade through this period and what sort of guidance that they're prepared to give going forward is going to be absolutely crucial to the market going forward. And it's just worth pointing out, I think, that there remains quite a big gap between the bottom-up forecasts of analysts and some of the strategists that we hear, and been quite vocal in markets about the gap between bottom-up earnings and top-down forecasts has never been bigger. And I know we ourselves are quite cautious about that, not least actually because of the currency. We've talked about the impacts of the currency. I was just literally doing a conference call, going back to doing a conference call that was hosted by the Estee Lauder management just before September. And Estee Lauder's a share we don't own. It's a company we absolutely have the highest regard for. You and I did a meeting with management there some years ago. Always felt it was a share we should own. Stock's come back a long way. But their currency forecasts are predicated. Sterling was 121, I think, against the dollar, and all other currencies were a lot higher. So there's more currency downgrades to come from lots of companies through this period, and of course the likelihood that they strike cautious guidance given everything we see. So we feel like to become more constructive, to want to start putting money to work in these markets, we would like to see these earnings reset at a more, what we would say, conservative level going into 2023, and analyst estimates come back. And I think that could set up actually quite a strong rally for markets if we get that, and with, of course, the caveat that we don't see a sort of tail risk event from all this incredible volatility we've seen. So we're going to stay cautious. We're at 12% cash. As I said before, a lot of that is held in dollars. It's been a very challenging environment. We're trying to navigate our way through that, and we'd like to get more constructive, given that, as you said earlier, Charlie, we feel like the market knows where we're at now with the Fed. And one thing, we could have touched upon earlier, maybe you just want to finish with one comment on this, is the one thing we know about the dot plot is it's never usually right. Now, directionally, it could be wrong in either direction this time, but it's, it is a broad range of different estimates by different federal governors. And, it comes together as a consensus, and it is rarely right. So, any thoughts on that just before we wrap up?
Yeah, I think as you said, when you look at the 20, in terms of the US specifically, when you look at the 23 dot plot, I think we know where we are there. But the longer out you go, or the further out in the years you go, the more wider dispersion there is in estimates. So I think which highlights the big differing of opinions amongst Fed members as to where inflation might be, how long rates need to stay this high for. And I think in the UK as well, the recent Bank of England, the MPC meeting that happened just before the mini budget the other week, there's again big dispersions in terms of how much rates should go up there. Some spoke to 75 basis points, majority at 50, some are even at 25 basis points. You've got this big dispersion of estimates as to what people think should be happening right now. And they're trying to talk to investors through the media in terms of these endless speeches that Fed members are giving to try and emphasize that they're staying the course in terms of this effort to get inflation down. And I think, yeah, as you said, if you look back, dot plots have never really been any indication about where rates are likely to go. They're more indication of what their members are thinking right now. At least, I think, in our opinion, that's the way we view them.
And of course, this time last year, I think the Fed dot plots reflected the idea that inflation was transitory, and now they reflect that inflation is absolutely persistent. So, it remains to be seen, where the truth is. And we have been of the view that inflation would persist at a higher rate, and that is still our view going forward. But that is, I think, well understood by markets now, and we are seeing, without question, some easing in supply chain related issues. That is something I picked up in the US last week. So, in amongst all these very, very difficult scenarios that we're painting and somewhat gloomy picture, as I said earlier, if we can see earnings estimates come back to a more realistic level for 2023, given that we know where we are with rates, and as long as there isn't any nasty tail risk event lurking in the long grass to really upset markets, then I think there is room to be more constructive between here and the year end for us to put money to work. So on that note, I will be closing the meeting now. Thanks so much for your time and your as ever insightful comments about the Federal Reserve and those rate related issues, and look forward to communicating with investors again very soon. Thanks for your time.